Hi, this is Mary Kopczynski, the CEO of Rengalytics, with your update on this week's 38,640 alerts from over 13,000 agencies globally in 190 countries and 26 sectors. I'm again recording from the RV. We're week 2 at Jellystone. It's raining, and I've been watching a regulatory story build in our data for the last few months, and I think it's time to talk about it. The regulator of the week is the SEC, and the topic is fast track IPOs. So what tipped me off this week was a letter from Elizabeth Warren to the S&P Dow Jones, Morningstar, NASDAQ, and FTSE Russell indices. First of all, Elizabeth Warren is prolific, okay? She writes a letter almost every day pointing out some worrisome issue or another, and I don't want you to jump to any partisan conclusions because I do want to talk about this from a structural perspective, okay? Remember, I met the founders of Rengalytics writing the living will for Credit Suisse, which is a document Credit Suisse was supposed to write in the event that they might have gone into bankruptcy, okay? When we were writing that thing, we thought it was a joke, that it would never actually happen, but it did, and it is thanks to the incredible investment from the regulators, the industry, Credit Suisse, and all of us that the failure of a 167-year-old institution did not cause another enormous financial downturn. So I believe in a certain amount of regulatory investment in the markets to make them safe. At the same time, I also understand that regulation can be stifling. And just a few weeks ago, I talked about IPOs and the fact that in the 90s, we had over 8,000 public companies, and now we only have 4,000 public companies. There's probably too much regulation going on. But to get you where I need you to get to is to go back to Paul Atkins, the new SEC chair that is trying to make IPOs great again. So let's go back to May 1st of this year. Quietly, with very little fanfare, the NASDAQ 100 index changed its rules. The changes, which were filed via the SEC, introduced 3 things, one of which was something called a fast entry pathway for the largest new listings. The idea was that if a company's big enough, it can skip all the traditional waiting periods and get into the top NASDAQ 100 index faster. Before this rule, you had to season your IPO for a few months just to make sure it was safe so that, before you could really be at the top of that list, because everybody buys index funds in that list because it's the top companies in the world. But now, if you're enormous, you don't need to wait. So about 3 weeks later after this rule change, on June 3rd, we picked up another alert in our data. Now, this one was from Coinbase. They announced that they were launching pre-IPO perpetual futures on a private company starting with SpaceX. That's a product where traders outside the United States could take price exposure to SpaceX before it even went public. The regulatory alert was just a blog post, very simple, but it told you everything you needed to know about what was coming. Then, on June 10th, Senator Elizabeth Warren wrote a 12-page letter to the SEC chair, Paul Atkins, asking him to delay the SpaceX IPO. That letter is also in our system as a press release from the Senate Banking Committee. So Warren's concerns were threefold. So, 1, the valuation of SpaceX was targeting a $1.75 trillion valuation on only $18 billion in revenue, and a nearly $5 billion net loss in 2025. 2, the governance. So Elon Musk would control 82% of voting power after the IPO and can only be removed by a class of shares he personally controls 93% of. And then finally, 3, this index question. She argued that passive fund investors, like people with 401ks and pension funds who never chose to own SpaceX, were going to basically be forced into it through it being included in the top 100 index funds, right? They wouldn't have any say. It just would be automatic. Because really, NASDAQ 100 is considered safe, right? So a company owned by basically one guy that skipped the line, even though it's losing double of NASA's annual budget, could now be in pretty much everybody's investment portfolio, right? And that could be perceived as risky. And then here's the quiet alert most people missed entirely. Also on June 10th, SIFMA, which is the Securities Industry and Financial Markets Association, filed a no-action request with the SEC's Division of Trading and Markets. They asked the SEC to confirm it would not take enforcement action if broker-dealers temporarily reduced customer reserve requirements to handle the flood of cash coming in for SpaceX purchases. Basically, the IPO was going to be so large, it would create a short-term liquidity crunch at the broker level. The SEC quietly granted it. That means this was so big that following normal investor protection rules to the letter would have created a mechanical bottleneck in processing all the trades. So the SECs gave the broker-dealers a one-day pass to handle settlement kind of after the fact. The very next day, June 11th, Warren sent the letter that I mentioned at the beginning, which is the one to the index providers. She asked them point blank, did you change your rules because SpaceX or Elon Musk lobbied you to do it? She wants responses from these guys by June 26th, which is this Thursday. And then on June 12th, the SEC let the IPO proceed. SpaceX, of course, listed at $135 a share, raised $75 billion, the largest IPO in history, and surged more than 20% in day one. Warren issued a statement calling the valuation nonsensical and saying the SEC had failed ordinary investors. So what do you think? Is it que sera, sera, buyers beware? Or should we be worried? I don't know. You tell me. That's it this week for Regalytics. We have the global supply chain of the world's regulatory alerts in one very easy-to-use place. If you need a solution for anything related to regulation, give us a call.